It is Thursday morning, June 25th, 2026, and pre-market, the bell has not rung yet, but the implied open is already painting just a massively divergent picture across the indices.
Yeah, it's completely split right now.
Right. We're looking through this stack of pre-market research, institutional sheets, overnight tech earnings, and the split is stark. Look at the blue chip Dow. It's sitting essentially flat. But Nasdaq 100 futures, they are just ripping higher, up over 2%, pushing past that 30,060 to 30,123 range. S&P 500 futures are trailing a bit, but still up, what, about 0.6%?
Which is a huge structural move for the overnight session.
Exactly. I mean, the overnight session was completely dominated by sheer, unadulterated semiconductor revenue. It's setting up a textbook gap-and-go scenario for tech at the bell. Looking at the markets today is like watching a rocket trying to launch while someone is actively bolting it to the launch pad.
That's the perfect way to phrase it, honestly, because the elephant in the room is what's waiting at 8:30 a.m. Eastern.
The PCE print.
Right. The May Personal Consumption Expenditures Index. Fed Chair Kevin Warsh has made it explicitly clear over and over that this is his ultimate inflation gauge.
His absolute favorite metric.
Exactly. So we have this explosive micro-catalyst from AI hardware crashing headfirst into the heaviest, most restrictive macro data point of the month. If you are an active trader managing a portfolio right now, you really have to keep this central tension in mind.
Yeah. You're navigating a market where hyper-growth catalysts are just violently colliding with heavy macrogravity. Okay, let's unpack this microcatalyst first, because the engines driving the Nasdaq up over 600 points from yesterday's low, they're purely fundamental.
We aren't looking at speculative press releases here.
No, not at all. We are looking at tangible physical hardware revenue. Micron Technology and Qualcomm both dropped overnight numbers that are just completely reshaping the semiconductor landscape.
The scale of the beats is what's really staggering.
Right. Micron is surging over 17% in the pre-market, blasting past $1,228.09 a share. I mean, they crushed fiscal Q3 revenue at $41.46 billion. But the real catalyst was guiding Q4 to a massive $50 billion.
Which is wild.
It obliterated the $43.2 billion consensus.
And the structural driver behind that $50 billion number is HBM high bandwidth memory.
Right.
To understand the scale of this, you have to look at how AI data centers actually operate on a physical level. You can have the fastest, most advanced AI processors in the world, but they are entirely useless if they can't be fed data fast enough.
They just sit there idling.
Exactly, they starve. So HBM physically stacks memory chips vertically to drastically shorten the distance data has to travel, right? It eliminates that bottleneck. But Micron is severely supply constrained on this specific architecture.
Basically sold out.
Completely. Their entire order book for HBM is fully committed and booked solid through the end of 2026.
Wow. We've heard AI thrown around for years now, like just as a corporate buzzword. Is this just more speculative fluff, or is there a genuine physical bottleneck here? Because if AI is a new digital city being built, Micron isn't selling the architectural renderings of the city.
No.
They're the only ones pouring the concrete. And they just told the market they are sold out of concrete until 2027.
What's fascinating here is how the mechanics of the overnight session reacted to that exact realization. The semiconductor sector was actually pulling back heavily over the last 3 sessions.
Yeah, it's getting ugly.
Institutional sellers were attempting to force a major structural breakdown yesterday afternoon, but Micron's earnings slammed that bear trap shut.
Just locked them in.
Right. Late short sellers were caught completely off guard, which forced this rapid covering that squeezed prices higher, and that localized short covering. It catalyzed a massive global rally.
Yeah, I saw the Nikkei in Japan surged over 4.1%.
And South Korea's Kospi jumped 5.9%. It's a global shockwave.
And Qualcomm is throwing just as much fuel on the fire right now. They're up nearly 12% in pre-market volume, clearing $220.61 following that blockbuster investor day in New York.
The Dragonfly C1000 CPU.
Yes, the Dragonfly, custom built for Meta's data centers. But the piece of the puzzle that really stands out in all these institutional notes this morning, it's their $3.9 billion all-stock acquisition of an AI software startup called Modular.
Yeah, that acquisition is a direct, calculated assault on NVIDIA's primary moat.
Because NVIDIA's moat isn't just hardware, right?
Exactly. NVIDIA's dominance isn't just about their silicon. It's about CUDA, their proprietary software platform. For years, if you wanted to write code for AI workloads, you wrote it in CUDA.
Which means you're locked into running it on NVIDIA hardware.
Right. It's an ecosystem trap. You can't just swap the chips out. Modular, however, has developed a hardware-agnostic platform. It essentially acts as a universal translator.
Oh, wow.
Yeah, developers can write their code once, and Modular compiles it to run on any hardware, Qualcomm, AMD, custom silicon, whatever.
Yeah. So by acquiring Modular, Qualcomm is basically attempting to commoditize AI hardware.
Allowing enterprise clients to swap out NVIDIA chips without having to rewrite millions of lines of code.
Which explains why Qualcomm felt confident enough to raise their non-handset revenue target to $40 billion.
They're pivoting away from just being the chip inside your smartphone.
Right. They're aggressively attacking the data center rack. So we have these tech giants generating absurd amounts of cash, completely supply constrained, with massive forward guidance. That is the bull case.
That's the micro.
But those valuations do not exist in a vacuum. They have to survive the broader cost of money. And right now, the cost of money is putting an absolute vice grip on multinational tech companies. Here's where it gets really interesting. Operating a multinational tech company right now is like trying to run a sprint with a weighted vest.
The two primary mechanisms of that vice grip are Treasury yields and the dollar. If you look at the terminal this morning, the 10-year Treasury yield is sitting at 4.41%.
Which is still high.
It is. Now, it has eased slightly from a recent peak of 4.50%. And that's primarily because those U.S.-Iran peace talks have brought Brent crude oil down to roughly $69 a barrel.
Which temporarily cools off some of those immediate headline inflation fears.
Right. But from a structural cost of capital perspective, 4.41% remains highly restrictive.
And the other side of that macro squeeze is the U.S. dollar index, the DXY. It's currently highly elevated at 101.52, which is right near a 13-month high.
Propped up by the Fed.
Yeah, the catalyst keeping the dollar so elevated is the persistent hawkish rhetoric from Warsh. Fed funds futures are currently pricing in an 83% probability of a December rate hike. The strong dollar means your products are instantly more expensive overseas, and the high yields compress the future value of your cash flows.
If we connect this to the bigger picture, you see how a 101 handle on the DXY acts as a direct foreign exchange tax on these companies. A strong dollar physically erodes margins.
Right, because of the currency conversion.
Exactly. When an enterprise software company sells a cloud package in Europe or Japan, those local buyers are paying in euros or yen. Because the dollar is so strong, that exact same software effectively just became 10 to 15% more expensive for the foreign buyer.
Which suppresses demand.
And even if they make the sale, when that tech company repatriates those foreign earnings back into dollars to report on their balance sheet,
they take a massive conversion haircut.
Exactly.
And even if a company like Micron manages to beat those currency headwinds and post a $50 billion quarter, that 4.41% 10-year yield is actively compressing what institutions are willing to pay for every single one of those dollars.
Because it all comes down to the fundamental reality of the discounted cash flow model.
Right.
Growth tech valuations are heavily reliant on projected cash flows 5, maybe 10 years in the future.
Yeah.
To figure out what the company is worth today, you have to discount those future profits back to the present.
And the risk-free rate, that 10-year yield, dictates the discount rate.
Exactly. If you can get a guaranteed risk-free 4.4% yield from the U.S. government today, a theoretical profit in 2036 becomes mathematically less valuable.
Which lowers the ceiling on how high-tech multiples can trade.
When the yield spikes, the present value of future tech cash flows collapses. That valuation compression is the exact mechanical reason the Nasdaq shed nearly 1,000 points earlier this month.
Right, before this overnight AI rescue operation stepped in. So the pre-market is a massive tug-of-war between record-breaking micro-earnings power and an unforgiving macroeconomic discount rate.
A total battleground.
Institutional traders are hyper-focused on this specific tension. But while the smart money is sweating over the 10-year yield and the impending PCE print, retail traders are focused on a completely different ecosystem.
Oh yeah, the meme stock side of things.
Let's look at the top pre-market gappers, because Wendy's ticker, WEN, is doing something surreal right alongside this AI boom.
The pre-market volume on Wendy's is just a classic anomaly.
It's insane. They traded 202.2 million shares on Wednesday. That is astronomically high, something like 1,500% above average volume. The stock closed up nearly 25.7% yesterday, and pre-market today, it is dapping up another 12.3% to $8.83.
Driven by what exactly?
Well, the catalyst being cited is Wendy's hiring Steve Cirulis as their new CFO and Chief Strategy Officer. Retail is framing this as a massive turnaround play.
The executive hire is irrelevant to the price action.
Right.
What matters is the market structure. This is a highly coordinated retail campaign orchestrated across forums like Reddit's or Wall Street Bets. They're targeting a very specific vulnerability.
The short interest.
Yes, Wendy's had an estimated short interest sitting somewhere between 23 and 32% of its free float. Retail traders saw a heavily shorted, low-float legacy brand, and they weaponized the liquidity.
They launched a Save Wendy's campaign.
Exactly. It is a pure mechanical short squeeze driven by momentum. It's entirely detached from fundamental reality.
And the fundamentals are objectively terrible. Same restaurant sales just fell 8%, and net income dropped 42% in their last report.
Which is why the shorts were there in the first place.
Right. So if a stock like Wendy's can fly this high, with hundreds of millions of shares changing hands based purely on narrative and forced buying, does all this macro data and PCE inflation stuff even matter to the average trader? Are everyday retail traders simply ignoring the macro data?
This raises an important question about retail psychology and where the real liquidity traps are hidden. A large segment of retail traders are playing a momentum game, right? Chasing meme stock squeezes or blindly trying to buy the dip on tech without understanding the cost of capital gravity.
Yeah.
But by focusing on Wendy's, they're completely missing the massive structural hazard that institutions refer to as the pain trade. Specifically in this environment, it's the double loss liquidation.
Okay, break that down, because the assumption for decades has been the 60-40 portfolio. You hold 60% in equities and 40% in long-term bonds.
Right.
When tech or equities take a hit, the traditional retail reflex is to rotate capital into those long-duration bonds for safety, assuming the bonds will catch the fall.
But that historical correlation entirely breaks down in a hawkish, high-inflation environment. It all comes down to duration risk. Bond prices and bond yields have a strict inverse relationship.
Okay.
So if today's PCE print comes in hot, validating Warsh's hawkish stance, the 10-year yield will instantly spike. And when yields spike, the prices of long-duration bonds crater.
So the 40% of your portfolio that was supposed to be a safety net is suddenly bleeding value.
Exactly. And simultaneously, as we outlined with the discount rate, that exact same yield spike mechanically compresses tech valuations.
So the 60% equity side of the portfolio drops at the exact same time.
That is the double loss liquidation. The traditional safe haven becomes a landmine. For anyone listening, managing capital right now, hiding in long-term bonds ahead of this inflation data, is a trap.
A massive trap.
Catching a falling knife in high multiple tech while yields are rising is equally destructive. We have the VIX, the volatility index, hovering near 19 right now.
Which implies daily expected moves that will easily blow out tight stop losses.
Exactly. In this specific macro environment, short-term T-bills and outright cash are the true institutional safe havens. They protect your principal while providing a yield well above 4%, allowing you to just set out the volatility until the macro picture clears up.
So what does this all mean for the opening bell? We've dissected the physical bottleneck in AI memory with Micron, Qualcomm's strategic assault on NVIDIA's software moat, the currency translation tax of a 101 DXY, and the mechanical destruction of the 60-40 portfolio.
It's a lot to process.
It is.
Yeah.
But if we distill all of this pre-market data, we are looking at an absolute institutional battleground over the next few hours.
It comes down to the line in the sand technical levels.
Right.
These are not arbitrary numbers. These are deep institutional liquidity pools where algorithms and large block traders have parked their stop losses and defense mechanisms. For the S&P 500 futures, the core pivot zone is 7,452 to 7,452.
So bulls absolutely have to defend 7,452 at the open.
Without question. And for the Nasdaq 100 futures, the line in the sand is 29,650. Reclaiming that zone overnight was a massive structural win, but it is fragile.
If the PCE inflation print comes in hot, how fast do those liquidity pools drain?
Instantaneously. If PCE is hot, yields spike, the dollar surges, and those technical floors will snap.
Brutal.
If the Nasdaq slips back under 29,650, this massive pre-market rally gets confirmed as a long liquidity trap. The market will flush as the smart money dumps their AI exposure to reprice the discount rate.
But on the flip side,
Right, if the PCE print comes in cool, or even perfectly in line with expectations, the macro vice grip loosens. Yields pull back, the FX tax on the dollar eases, and that tangible AI hardware momentum we saw overnight has an unencumbered runway to push the market back toward all-time highs.
so it's a completely binary setup.
Which is why the strategic play for an active trader is absolute patience. Do not chase the open. Let the market algorithms digest the PCE data. Protect your capital. Hoard cash if you see that 10-year yield pushing back toward 4.50%. And just wait for the valuation dust to settle.
Patience is key.
Yep.
Look, before we wrap up this deep dive, there's a broader structural question you should consider, something beyond just today's trades. We've unpacked this intense collision between the physical, capital-intensive demands of AI infrastructure and the restrictive nature of hawkish Fed policy.
Right.
But what if this tension isn't just a cyclical phase? If we are entering an era where building the foundational hardware for AI requires so much capital that it completely overwrites traditional market cycles, and simultaneously a hawkish Fed structurally neutralizes the safety of the 60/40 portfolio, are we witnessing the permanent death of traditional valuation models?
That's the real question.
Do the old rules of investing even apply to the next decade of trading, or are market participants relying on an outdated map? The data at the opening bell will give us the first clue. Keep your eyes on the yields, watch those liquidity pools, and we will see how the market digests the print.